I think it's safe to say that the days of $150 yen being this magical line in the sand are well and truly over. Like for a long time, this 150 level, the turquoise one you can see on screen here, was the point beyond which the market assumes there would be intervention from the Bank of Japan. So this meant leading up to the level, we had a lot of consolidation, and around that level, there were lots of great ranges that we could trade. Then when the yen did dip past that level, we'd see sharp movements back. Like if we go back a few weeks to this one in October, price moves through 150, sharp correction all the way back down to 147, like pretty much instantly. Now, it wasn't necessarily the case that all of these were directly the Bank of Japan intervening each and every time. It's also the methods that they used to influence the market in a way that had the equivalent effect of an intervention, like requesting quotes from dealers and expecting to then be front run on any potential intervention, so effectively the market does their job for them. But all in all, what this meant was that there were some great trading conditions, because around 150 you could either trade it as a range, going short from the top knowing that that's a backstop, or even de-risk the trade based on the range and then hold the rest of the position for a sharper correction. Or we knew every time the price was edging its way upwards, it was going to get a bit hesitant as it closed in on 150 and have pullbacks, and that was great trading. But now, as you can see from this sharp move upwards that we've been seeing today, I think it's time to finally say RIP to the 150 level. The price on the weekly basis may still struggle to clear it convincingly, but it's definitely not going to be seen as that magical level anymore, and I believe that the Bank of Japan will be willing to let the price drift much further before they take any intervention action, if at all. You see, the Bank of Japan is in a pretty tricky situation at the moment, and it's largely down to their own making. In the current situation, intervening heavily around 150 would end up being like a drop in the ocean. It might cause like a pullback temporarily, but eventually the yen is going to continue to weaken. Dollar yen is going to march forward and march forward, as we're seeing now, above 151 and continuing to push higher. And it's down to the Bank of Japan's monetary policy. Yesterday afternoon there was this rumour that they were going to adjust their yield curve control, and we saw this sharp bearish move down here, following on from the bearish structure we saw beginning on Friday after, once again, we'd pushed above 150. I think it was around Wednesday evening UK time, early hours for Japan. And if you're not sure what yield curve control is, we did release a video on it a few weeks ago, so you can click up here, we'll put it up there for you to watch it. But the problem is, when the announcement actually ended up happening, so when the Bank of Japan announced their monetary policy rather than it being the rumour, it was a disappointment. Firstly, they remained dovish and suggested that they'll patiently stick with their accommodative policy since they forecast that inflation will get back below 2% by 2025. And secondly, their changes to the yield curve control were, in my opinion, weak. They announced this: given extremely high uncertainties over the economy and markets, it's appropriate to increase flexibility in the conduct of yield curve control. Now look, everyone knows that they need to scrap the yield curve control. It's like a currency peg. It might serve a purpose for a while, but these things never sustain well over the longer term, and their yield curve control has definitely overstayed its welcome at this point. But if they just remove it straight away, it could cause huge disruptions in the markets. So by taking this approach of being flexible, it's almost like they've started an orderly exit from it. I mean, think of it this way. The whole point of their yield curve cap is that as the yield starts to close in on that 1% cap, they would then conduct daily bond buying operations and bring the yield back down. But now they're not going to be doing that anymore. So what good is a yield curve cap if every time they reach it, they go and announce that they're making an adjustment in one way or another that means that they can pass through it? It's like when a trader has a stop loss, but every time the price approaches it, they're moving that stop loss along and along, then it basically means you have no stop loss. So for the Bank of Japan, you effectively have no yield curve cap because you're willing to be flexible around it. So going back to the yen, the problem with yield curve control is that as the yield approaches the cap, they have to go through effectively easing and print more yen to defend the yield cap. And this obviously weakens the yen, which is what we've been seeing. Then at the same time, if they're not allowing yields to rise, the differential between JGBs, the Japanese government bonds, and the US bonds is increasing. And the yields on US bonds have been exploding recently, so it's getting even wider and wider. So this is obviously going to weaken the yen even further against the dollar because more money is going into US bonds than Japanese ones due to the yields being better. So these are actions that they're choosing to take, But the ridiculous logic here is the opposing action that they're also taking, or at least they were when they're intervening. You see, when they do currency intervention, they're selling dollars to defend the yen. Now, this setup might work in the short term, but it's insane to think that this is sustainable over the long term, that they're printing more yen to defend their yield cap and then selling dollars to defend the yen. It's like, what is this messed up situation that they're in? And as the US yields have risen more and more, it's becoming more and more difficult to maintain that 150 level. So it seems now a more suitable area would be at least 152 to 153, which, you know, we're closing in on it. It's 151.3 pretty much at the moment. Now, if we switch to the weekly chart, I have this zone that I'm waiting for. So it's based on the high from October last year, which is around 51.80, and it's going up to the significant level we have just above that based on the Duomo method, which is just below 52.70. So around that zone, if the price gets there, and to be honest, it's getting there pretty quickly at the moment. So if it gets there and momentum is dying out, then I'd be interested in revisiting short moves. But depending on what happens next, and if the momentum's higher, we could go further. And actually, we have a much stronger level at 156, around that area, I think 156.3, which we'll discuss sometime in the future if the price gets up there. And of course, we have other big events that could disrupt things this week. We have the FOMC meeting later this week, we have NFP coming on Friday, and we have the second part of the US Treasury's quarterly announcement. So on Wednesday, we'll get to see the distribution of the issuance of their borrowing, and the expectation is that they might do some sort of twist and issue relatively more bills and fewer coupons so they can make use of the huge demand at the short end and reduce the concerns about oversupply at the long end. But with all else remaining relatively the same, I'd be looking to go long when there are any sharp pullbacks in dollar yen, like what we saw yesterday when the rumor hit the market. If we go back to the hourly chart, we can see situations like this, I'd be looking to go long because I think that the yen is going to continue weaken if it's around this sort of area. And obviously, if we push much further, there's a lot of momentum, and we push beyond the 152, 153 zone that I was talking about, then, as I said before, we have a great level around 156, but we'll discuss that another time if we make it up there. Now, I'd love to know your thoughts in the comments. What are you seeing dollar yen doing from here? What do you think the situation is with the Bank of Japan, and what are they going to do next? Will we see any more currency intervention from them? And assuming they keep their interest rates as they are, do you think the yen will keep creeping lower, or will we see some limit somewhere? Is there a level around here that you're keeping an eye on? We have lots more data coming up later this week, and we'll cover more of it on this channel as we adjust back to how this channel was meant to be. When we started this channel, it was intended to be more frequent videos, less scripted, more in the moment, covering situations that are moving the markets. And now that the Duomo Traded Development Program is finished, it means we can refocus on that type of content. So you can expect more of it Monday to Thursday, so during the week. And hopefully I'll get more practice at doing this again so they could be a bit more free flowing. But anyway, thanks for watching. Leave your comments below and I'll see you in the next one.